Have you ever taken a trade after a breakout only to watch the market reverse and hit your stop loss? It's frustrating, right? You believe the price is breaking out, but in reality it's just a fake out. The good news is there's a straightforward yet effective strategy that helps you filter out false breakouts and enter trades with conviction. It's known as the break and retest strategy. In this video you'll discover how to spot a genuine break and retest pattern, the ideal entry zones to dodge fake moves, how to apply this in both bullish and bearish markets, the most common errors traders commit, and how to steer clear of them. By the end you'll walk away with a clear, actionable guide to trade break and retest like a seasoned pro. Before we jump in, be sure to hit that like button, subscribe for more trade tactics, and enable notifications so you don't miss future updates. Let's begin. The break and retest strategy remains one of the most reliable methods for entering trades with certainty while steering clear of fake breakouts. Rather than diving in the moment price breaks a level, you hold off and wait for a retest confirmation before taking action. Here's the process. Price pushes above a key resistance area indicating possible bullish strength. Instead of jumping in right away, you allow price to pull back and retest that area, now acting as support. If the level holds and price bounces, that's your green light to go long. This method helps you sidestep fake breakouts that catch early traders off guard, align with the market momentum, and secure a more favorable entry with improved risk to reward. The exact same logic holds true in bearish conditions when price drops below a support zone. Before you can effectively use this method, it's crucial to grasp the market psychology behind the break and retest setup. When price breaks through a major resistance level, it indicates that buyers have taken control, driving the market upward. Traders who got in early ahead of the breakout are now sitting on gains. But here's the thing, markets rarely move in a straight path. As price advances, those early buyers begin to secure profits by selling, which leads to a pullback. This isn't random, it's driven by traders closing positions, adding selling pressure and pulling the market lower. Now if you jump in right after the breakout, you risk getting caught during the pullback. This is the mistake many traders make. The smart money, the same participants who exited near the high, are now waiting to re-enter at a better price, and the optimal re-entry zone is the old resistance, now acting as support. Once price returns to that level and shows a rejection, it signals renewed buying interest. That's your entry cue. This way you're trading with the flow of the market, not against it, and you're using the break and retest approach the correct way. Now that you know why this strategy is effective, let's shift focus to the core concept that supports it all: market structure. To use the break and retest method successfully, you must have a solid grasp of market structure. This allows you to identify high probability trade setups and steer clear of avoidable risks. The market flows through three distinct phases, and during each phase price responds uniquely to important levels. In an uptrend, price creates a series of higher highs and higher lows, indicating that buyers are dominating. But here's the deeper view: buyers are entering at strong support zones and exiting near the highs. As price climbs, every resistance that gets broken becomes a key level, a zone where buyers may consider re-entering on a pullback. When price revisits a broken resistance level, buyers often return and drive the market upward. That's why in an uptrend you don't buy just anywhere. You wait for price to retest a previous resistance and confirm rejection before making your move. In a downtrend, price moves by forming a pattern of lower highs and lower lows, indicating that sellers are in control. Here's what's going on beneath the surface: sellers open positions at strong resistance zones and close them by buying back at lower levels. Each time support is broken, it becomes a key area where sellers may look to re-enter. When price pulls back to retest that broken support, sellers often return and push price further down. That's why in a downtrend, jumping in too early can be risky. You wait for price to revisit a previous support and confirm rejection before considering a short entry. In a range, price fluctuates between support and resistance, showing that buyers and sellers are in balance. Unlike trending markets, a breakout by itself doesn't guarantee that price will keep moving in that direction. Breakouts can often be deceptive, which is why waiting for a pullback or retest becomes crucial. If price breaks above the range and revisits the old resistance level, it suggests buyers are starting to take charge. Without a retest, you're simply guessing on the breakout rather than acting on confirmation, and that's a common trap for many traders. Now that you have a grasp of market structure, let's dive into how to spot a high probability retest, because not every pullback is a setup worth trading. To use the break and retest strategy correctly, your focus should be on confirmation, not just the break of a zone. Here's how you approach it: identify a clearly defined level where price has reacted several times before. Weak zones that didn't hold price well are more likely to break again. In this case, we're looking at a major support zone. Instead of jumping in right after the break, you allow price to retrace. This is where experienced traders prepare to act. When price comes back to the broken support, your job is to watch what price does next. You still don't enter, you're waiting to see if that zone now behaves as resistance. This is the critical critical point. If price shows clear rejection using strong price action signals like pin bars, engulfing patterns, or repeated wick rejections, it suggests sellers are re-entering and driving price down. Once that rejection is confirmed, you enter a short trade and place your stop loss just above the retest area for safety. The same rules apply when resistance is broken after the breakout. Wait for the retest and rejection before going long. We've covered how to trade the break and retest strategy in a trending market. Now let's look at how to apply it in a range-bound market where price fluctuates between support and resistance. In this type of market, price moves back and forth with no clear direction. To trade a breakout effectively, follow these steps. Wait for the range to be broken. Wait for price to return to retest the broken area. Enter only when you see confirmation. Why should you wait for the retest? Entering right after the breakout is risky since early buyers often close positions, causing a retracement. The safest entry comes after price revisits and rejects the broken level. This retest confirms that the breakout is valid and raises your chance of a winning trade. Now here's something most traders miss. Just before a breakout, the market often grabs liquidity beneath support. Here's what happens: liquidity builds below support as many traders place stop losses and pending buys there. The market dips below support, triggering those orders and trapping sellers. Then price quickly reverses and breaks out in the opposite direction. Let's look at another scenario here. Price breaks below the support level, indicating that sellers are now in control, but your role as a trader isn't to chase the breakout, it's to be patient and wait for the retest. Why is that? Because right after the break you have no certainty about what comes next. As shown here, the market pulled back and retested the broken support level, which now acts as fresh resistance. This happens because many traders view that level as a solid place to sell again. Sometimes you'll get the retest, other times you won't, and that's perfectly fine. You need to adjust your mindset around missed trades. If price doesn't return for a retest, don't see it as a missed chance. Think of it as the market protecting your capital until a cleaner opportunity shows up. It's always smarter to skip a setup than to jump in too early after a breakout and take a loss. Now that you've learned how to approach range-bound breakouts with liquidity grabs, let's shift focus to the price action signals that validate a solid retest entry. A retest by itself isn't sufficient. You need strong evidence of rejection at the key zone before pulling the trigger. Here are the most reliable price action signals to watch for. The first pattern to pay attention to is known as wick rejections. When price revisits a critical level, one of the clearest signs of rejection is the presence of long wicks. This occurs when price attempts to break a level but gets snapped back quickly, leaving a visible wick. Why are wick rejections important? They reflect strong refusal. The market tries to push through a zone but fails, showing buyers or sellers are defending it. They also expose liquidity traps. Often smart money runs stops and reverses direction, leaving behind a wick that marks where others got trapped. The more frequent the wicks, the stronger the zone. It means price is struggling to break it, creating a high probability entry setup. When price breaks above a major resistance and then dips back to test it as new support, a bullish pin bar can be your go-to sign of a strong rejection. A pin bar is a candlestick with a long lower shadow and a small real body, showing that buyers stepped in during the retest phase. Here's the correct way to trade this move. Place your entry slightly above the high of the pin bar. Once it closes, this confirms that buyers are active and price may continue rising. Your stop loss should go below the pin bar's wick. If price drops past that wick, it's a red flag. The setup is invalid. Your ideal take profit zone is the next resistance level where sellers might push back. Aside from pin bars, other candle patterns work well too. Long-tailed bars, these show clear rejection as price fails to hold beyond a level. Dojis, these candles signal indecision and potential reversal, especially strong when they show up at a retest. The secret is patience. Wait for confirmation. Several wick rejections at the same level make the setup even stronger and boost your win rate. Here's something crucial: a lot of traders miss top-down analysis. Always analyze higher time frames first. It confirms that your setup fits the bigger market picture. This reduces bad trades and keeps you trading with the trend. If you want to deep dive into top-down analysis, I've got a full breakdown on my channel that walks you through it step by step. Now that you've got a solid grasp on trading wick rejections, let's break down another powerful price action setup: the inside bar pattern. Check this out on the chart. Price has been moving sideways inside a range, showing indecision between buyers and sellers. Then out of nowhere, buyers step in with strong momentum and break out above the range instead of continuing straight up, though price pulls back to retest that broken resistance, now acting as support. This is where things get interesting. At the retest, the market starts slowing down. Some traders expect a deeper drop, others aren't sure if the breakout will hold. Then boom, an inside bar appears. This is a moment of pause and compression. It tells you the market is gearing up for its next move. Inside bars show that price is temporarily consolidating as both sides battle for control. If price breaks above the high of the inside bar, that's your green light. Buyers are likely back in control and momentum could continue higher. Here's how to trade it: place a buy stop just above the inside bar's high. This confirms bullish intent. Put your stop loss just below the inside bar to manage risk. If price falls below that level, the setup is invalid. Your target The next key resistance zone where price might slow down or reverse. Now that you understand how to trade break and retest setups using price action, it's time to level up. Let's talk about spotting and trading reversals. We'll kick things off with one of the most reliable patterns out there, the double top. A double top is one of the most powerful and reliable reversal patterns used to spot the end of an uptrend and the potential start of a downtrend. It forms when price tests a key resistance level twice but fails to break through, signaling that buyers are running out of steam. Let's break it down step by step. First peak, buyers push price higher into a strong resistance zone but can't break it. Price reacts and pulls back. This dip usually finds temporary support where some traders might look to re-enter long. Second peak, price climbs again, testing the same resistance level but fails to break above the first peak. This is a sign of buyer exhaustion. The market's telling you there's not enough demand to push higher. Neckline test, price drops back down to the previous support level. This support line is now your neckline. If price breaks below it, that confirms a shift in market sentiment. Sellers are taking control and buyers are getting trapped. The retest after the breakdown, price will often pull back to retest the neckline. This is your key moment. Smart traders don't chase the move, they wait for this retest to confirm the former support is now acting as new resistance. When you see that rejection at the neckline, that's your high probability sell entry. Confirmation lets you enter with confidence, placing your stop above the retest zone and aiming for the next major support area as your target. Let me walk you through a live chart scenario. As you can see, the market has been trending upward with buyers firmly in control, but when price reached this zone it failed to create a new higher high and instead pulled back, marking the first top. Following this correction, price climbed again but couldn't push above the previous high, forming the second top. This illustrates the double top pattern, a classic signal that buyers are losing momentum and struggling to sustain the uptrend. The first top appears when buyers drive price into resistance, but it pulls back after failing to break through. The second top occurs when another attempt is made, but again price is rejected before surpassing the first high. The neckline is drawn by linking the low points between the two tops. This support line is key because once price breaks beneath it, we get a confirmation of a potential trend reversal. After the neckline is breached, many traders feel compelled to jump in, assuming the trend has flipped. However, this immediate entry can be risky because it might be a false breakout or a short-lived move where the market snaps back into the previous range. Instead, it's smarter to wait for a retest of the neckline, but also remember that sometimes this pullback doesn't take place, and that's totally fine. We're only focused on trades that offer high probability setups, and those only happen when the market aligns perfectly. In this chart example, we can see that price did return to test the neckline and formed a clear pin bar candlestick at this critical zone. This pin bar reflects strong rejection, suggesting the former support is now acting as resistance and price is likely to continue dropping. Now's the right moment to enter the trade. Place your entry after the pin bar closes above its high. Your stop loss should go right above the wick. Aim for the next major support level as your take profit. As you can observe, after the retest and rejection at the neckline, the market moved lower, confirming the trend reversal and giving us the early entry into a new downtrend. Just like the double top, the double bottom formation signals a possible trend shift, but in the reverse direction. Instead of suggesting a top is in place, the double bottom indicates the conclusion of a downtrend and the potential beginning of an upward move. As shown here, the market had been trending down with sellers maintaining pressure, but at this price area the market hit a significant low and instead of continuing to fall, it bounced upward. This marks the creation of the first bottom. Following the bounce, price moved lower again, but this time sellers couldn't push it beneath the initial low, forming the second bottom. This highlights that selling pressure is weakening and buyers are beginning to take interest, giving us an early clue that a reversal could be near. Now, with two bottoms around the same price zone, a neckline forms by linking the high points between the two lows. This neckline acts as resistance which bulls will attempt to overcome. In this chart, we can see that price pushed through the neckline, which provides confirmation that the downward trend may have come to an end and a fresh uptrend could be starting. At this stage, it's not advisable to jump in immediately after the neckline break due to the risk of a fakeout or trap. As mentioned before, patience is key. After the breakout, the price returned to retest the neckline and produced a pin bar rejection candle. This is a strong sign that the previous resistance is now functioning as support. That's the moment to act. Place your buy position after the pin bar closes above its high. Secure your stop loss below the wick and aim for the next important resistance zone where price could encounter hesitation, as demonstrated here. Following the retest and pin bar rejection, the market moved upward, confirming the reversal and validating the double bottom is a reliable entry signal. Like I shared earlier, always begin with top-down market analysis. Skipping this step puts you at risk of trading against the main trend, which often leads to losses. Analyzing the higher time frames helps align with the bigger picture and boosts the odds of a profitable setup. If you found this breakdown useful, don't forget to like the video and subscribe for more actionable trade lessons. Drop your questions in the comments and check out my other content to grow your trading skills. Thanks for tuning in, and I'll catch you in the next video.